Awesome. I'm here with Dennis Jimenez from CBRE Capital. CBRE was the nation's leading Freddie Mac small balance lender with over $1.5 billion in transactions, over 500 transactions they did last year. So Dennis, thanks for joining us.
Oh, my pleasure.
If you don't mind, just really quick, just to let us, our audience know, what are some of the awesome things that buyers should know about Freddie Mac small balance?
Okay, so Freddie Mac Small Balance Loans, it's a program that was designed and put together as an alternative to bank financing. One of Freddie Mac's missions is to provide liquidity in the multifamily market, and there was a segment in the market that was not being served properly, which is smaller multifamily properties. Typically, the type of financing that most buyers would obtain would be a bank or credit union type of financing, and those come with certain challenges. So what Freddie Mac did was design a program that mimics some of the features that the larger loans offer to big investors have, such as non-recourse, such as longer amortization periods, and long-term fixed-rate financing. And they combine that with some of the features that are benefits from bank financing, such as a ability to lock your rate at application, low closing costs, and just kind of an ease of that comes with a standard process. We found that one of the big challenges in the small finance world is that each bank has their own way of underwriting. So when you go to obtain financing and you talk to 5, 6 different lenders, they have their own criteria. It's very difficult to understand whether you're going to get the loan or not until the last minute almost. Whereas the Freddie Mac process, it is standardized almost like a single family residential loan.
Wow. Dennis, what does a buyer need to provide to you to streamline the process, both for them to make sure they're qualified and also for the property to make sure it qualifies?
Absolutely. So these loans are underwritten based on the property's cash flow. It's the main determinant on the loan amount and the value of the property. These are non-recourse loans, which means they don't require a personal guarantee from the buyer. And what that means is that we focus heavily on the property. So I suggest that when you're looking at investment opportunities in the early stages, that you share with us the property information. So that will be the profit and loss statements for at least the last 12 months, a rent roll, a property tax bill, and what the proposed price is. And with that information, we're usually able to provide some initial feedback as to what the loan amount is going to look like, what the terms might look like. The key principle, personal information, it's something that we can also take a look at that stage. It is not as critical. Their guidelines are very clear. So if the key principle meets the guidelines, unless something comes up during due diligence that is unexpected, it's pretty much a done deal. So again, we focus heavily on the property information, rent roll, property statements, and a tax bill. And of course, the broker's offering memorandum is a great help as well.
That's right. A good offering memorandum always helps.
Yes.
What are the requirements for the borrower? Is it okay if they have to have certain liquidity requirements? So they have no bankruptcies, credit score?
Correct. So the requirements are a personal balance sheet showing a net worth equal to at least 1 times the loan amount. And when we look at that, we count all the assets owned by the borrower, or the key principal rather. So if they own a business, the equity in the business is counted towards their net worth, equity in homes, equity in other investment properties, IRAs, pretty much everything they have. So on a loan that's $2 million, we require a net worth of $2 million. Now, if they have partners in the deal, we would count the partner's net worth towards their required net worth allocation as well. So we have found that when we have borrowers or buyers who don't meet the criteria on their own, they will partner up with somebody else, and that way we can meet their requirement. We also require cash reserves of at least equal to 9 months worth of debt service. So, and that is an amount that we don't escrow and we don't encumber. So it just needs to be sitting in a bank somewhere. As long as we know it's there, it's fine. But there's no ongoing covenant to maintain that liquidity. So once we close, then the borrower has access to that money and they can do whatever they want with it. With respect to bankruptcies, that's where it gets a little bit tricky. We do require to clean credit record, so no bankruptcies, no judgments or liens in the past 10 years. If there is something, we have been able to get around those issues and mitigate it somehow, but we would need to know up front. FICO score of 650 is the minimum, which is pretty easy for most people to achieve. And we also require some level of real estate experience management if they plan to manage the asset that they are going to buy. If they plan to hire a third-party manager, then we do not require the experience.
Dennis, what insights would you share with a first-time buyer as they're going into a Freddie Mac program to make sure they get off on the right foot?
Sure. I would suggest that first-time buyers, ahead of time, have a plan in mind as to what they want to do with the asset. So that usually would entail having at least some initial discussions with their attorney as to how they're going to structure their ownership entity, having some discussions with a potential management partner or management company so that they can understand what's entailed in the ownership process. And then from our perspective, having a good idea of what the property's financials look like so that when they talk to us, we can gather information that we need, such as the rent roll and the operating statement. Typically, we don't distinguish between a seasoned investor and a newbie, if you want to call it that. If the buyer has third-party management, professional third-party management, then from our perspective, it really makes no difference. So that's really the main determinant. As they gain more experience, they could request a change in management, and we would allow them to self-manage in the future. But usually the first one or two transactions, especially if the buyer does not live near the property, we would absolutely require a professional manager.
When a buyer is selecting the management company that they're going to choose to use, what are your recommendations and the qualifications that best fit the Freddie Mac program?
Sure. The qualifications for the management company are somewhat subjective. We require a company that has sufficient infrastructure to manage the asset. Now, for small properties, that typically means staff that works for the management company. Most small properties don't sustain payroll on their own. But so it requires a property management firm that has the access to that kind of resources. An AC certified tech, a property management professional, a leasing professional. So I would recommend that you look for companies that have experience specifically in small assets. There are a lot of management companies who only manage larger properties, which is a whole different animal. So the technical requirements from Freddie Mac are actually very simple. Besides just proving that the management company has the required experience, we require a formal management agreement that would clearly spell out the management fees that are going to be charged, the term of the management arrangement, and who is responsible for what. In addition, we require that the management agreement, that the borrower be able to cancel such agreement with a 30-day notice and no penalty. And that's to protect the borrower in case the management company does not do what they're supposed to do.
For the Freddie Mac small balance program, what are the loan to value that you're seeing in the market, and also, if you don't mind, the difference and the restraints you're going to see on a debt coverage ratio versus loan to value?
Absolutely. So Freddie Mac looks at two main factors when determining the loan size. That will be a loan to value, which is easy enough. On a refinance, it's based on the appraised value. On an acquisition, it's typically based on the purchase price. And they also look at a debt coverage ratio. Now, the debt coverage ratio means that the net income of the property needs to exceed the mortgage payments by a certain amount. So when we say a coverage ratio of 125, that means that the net operating income has to be 125% of the mortgage payment. Now, the actual coverage ratio and loan to value are depending on the property's location. So properties located in large markets such as Miami, New York, San Francisco, they're subject to the least stringent requirements. You can have a coverage ratio as low as 120% or 120, and you can go as high as 80% loan to value. For properties in standard markets, such as Orlando and Tampa and Jacksonville. You can have a loan to value as high as 80%, but the coverage ratio has to be at least 125. Now, when you start moving into smaller markets, such as DeLand, Daytona Beach, then those requirements start to go up a little bit. So you're talking about 75% loan to value and at 130 debt service coverage ratio. That will also apply to Gainesville and the Panhandle. Now, we can also do loans in extremely small markets, so we can go in rural areas with very low population counts. In those instances, we can go as high as 75% on acquisitions, but then your coverage ratio has to be 135 or better. And on acquisitions, it's a little bit better. We tend to view a purchase as less risky than a refinance because there's actual cash equity at risk. So in that instance, you'll find that in a small market, those properties that are being acquired get slightly better treatment with respect to LTV and coverage than a refinance, especially a cash out refi.
When it comes to the debt coverage ratio, the most important number is the net operating income. What constraints do you put into the expenses for the net operating income, and also how do you calculate the income?
Absolutely. So we look at, on the income side, at two things. The rent roll in place. So we examine the rent roll and we estimate what the gross potential income or rent from the rent roll would be, assuming 100% occupancy. And then we make a deduction from that for vacancy, typically 5% in most markets. And then we compare that number, which we call net rental income, with the actual net rental income collected at the property for the past 3, 6, and 9 months. And we use the lower of those. So you have a rent roll minus 5%, or actual collections for the past 3, 6, or 9 months, annualized of course. And then we use the lower of the two. So that's how we estimate the income side. If there's other income items such as late fees or pet fees, we throw in the actual number. So if they have collected $10,000 for the past year for that item, we would actually give them credit for that as well. On the expense side, depending on the location, we would reassess taxes based on the sale. Now, some jurisdictions such as Orange County and Seminole, the assessor is very aggressive in reassessing, so we take that into account. There are other jurisdictions in smaller areas of the state where that's not the case. So it really depends. For the most part, you can expect to be reassessed. We will use a market estimate for the insurance because we still don't have the policy put together at that point. And then pretty much everything else is going to be based on actual expenses of the property plus an inflation factor of 3%. And we also deduct reserves, usually $250 per unit. So after those deductions, that will give you the NOI or net operating income. And that's the number that we will use to estimate coverage ratio.
When is it correct to use a small balance program from Freddie Mac versus a traditional bank loan?
Well, that's a great question. So typically, what we see is that bank financing is appropriate for situations where you need interim financing. So the property may be in transition. There may be high vacancy levels of the property. There may be a value add plan where the new buyer plans to invest funds in upgrading the property and increasing the value. So typically in those situations, the bank financing has more flexibility in exchange for a full recourse personal guarantee and in exchange for a shorter amortization schedule. Now, the Freddie Mac financing is what we refer to as permanent financing. So it is not intended for someone who has a short-term business plan that then needs to recapitalize. So our loans are intended to remain in place for at least 3 or 4 years, if not longer. We offer terms up to 10 years. So that kind of gives you an idea of the kind of buyer that we're looking for. It's more of a longer-term buyer. So it is more appropriate to use Freddie Mac financing when you are looking for permanent financing, meaning you're going to hold the property for a longer period of time, number one, or you need non-recourse financing, or you need the payments to be as low as possible because they're estimated based on a 30-year amortization schedule, which most banks will not do. We also offer interest-only payments for the first 1, 2, or 3 years. That also further helps the cash flow in the first couple of years, especially when you're just purchasing a property and there may be some changes that you want to implement, or you might want to re-tenant the asset, or just accomplish some other things. So it's good to have the extra cushion of a lower payment.
Dennis, share a few success stories that you've seen with recent clients.
Absolutely. So one of the features or aspects of the Freddie Mac financing that makes it so attractive is that it's a standardized process, so that you know what you're going to be getting from the beginning. So one of the things that we do is we help our clients basically buy the property. So when you're purchasing a property in this market, it's a very competitive environment. Every property that is out for sale gathers multiple offers, and there's multiple investors trying to get in there and purchase the property. So by knowing what the financing is ahead of time and having that certainty of execution that comes with a Freddie Mac SBL type of loan, the buyer is more confident in making an offer, and the seller is also more confident that that buyer will close. So we have several instances where it really came down to not necessarily a price differential between different offers, but rather the buyer was going to be using Freddie Mac financing. The seller was familiar with the program. They were familiar with us as well. They knew we could close on time, and there was a very strict time frame that we had to adhere to in the contract. And we were able to convince the seller to award the contract to our client. We committed within the time frame specified in the contract, and we closed on time, and obviously everybody was happy. We are also able to handle situations that are difficult for banks, such as people with income problems, because we don't look at income. The income that we underwrite is the income for the property. So I'm concerned about net worth. So we have had a number of clients who are retired. So their actual monthly income is not that high, but their net worth is sufficient to qualify for the program because they have enough assets. So that kind of borrower is ideally suited for the program as well. Borrowers who are foreigners, we're able to structure loans for people who are not U.S. citizens. So that has also been a benefit, as we've seen an influx of immigrants who come here legally, usually in the EB-5 program, but they're still not citizens. So they're working their way towards that. But they still want to invest in property. They want to take advantage of the opportunities here. And the program opens the door for that as well.
Sometimes in a deal you run into hiccups. Tell us about how you've worked through those with the Freddie Mac program.
Absolutely. Some of the common hiccups that we encounter have really to do with the property itself, or things are not known to either the buyer or the seller. Because the numbers, the rent roll, is something that is fairly easy to ascertain up front what the NOI is. So that's typically not the issue. Some of the issues that we find that are difficult to know up front usually have to do with environmental or survey matters, because it is not until that consultant finishes their work that you can actually understand if there's a problem. We recently had a property that was built in the 1930s. It was a historic building, beautiful apartments, wood floors, original fixtures, and it was gathering extremely high rents. It had a very high market value. When we were doing the engineering inspection, it turned out that we found an old boiler from the 30s sitting in the first floor in behind one of the garages. And the owner knew it was there, but didn't even think about it because it was decommissioned many years ago, so it was no longer in use. One of the issues with these old boilers is that they use heating oil or petroleum products to fuel the mechanism to provide heat or heat up the water. And they were stored in these tanks which after so many years start to leak, and here in Florida we have a very high water table. So the leakage from these fuels could actually contaminate the groundwater. So it was a huge concern. So we immediately got to work. We got another engineer involved, got some ground samples, turned out that the soil was not contaminated, and we immediately went ahead and closed the loan. And by the way, that boiler was removed after we closed the loan,
Yeah.
but it was not a problem anymore. It had not been used for many, many years. It was a relic from back in the good old days. So, but those are things that are very hard to to prevent up front. There's really nothing that you can do short of ordering an environmental report up front to prevent an issue like that. I mean, there's not much you can do about it. But we try our best to work around them, and usually we can.
Some of the older properties you run into the old FPE or Zinsco panels. You also run into some polybutylene, some copper piping. How do y'all work through those issues?
Oh, absolutely. So what we have seen is that all this new money coming into the multifamily space has the added benefit that many buyers renovate the properties. And when they run into issues such as the old electrical panels who could potentially pose a fire hazard, or the old polybutylene piping that could potentially burst, many times by the time we get to the financing, those issues have been addressed. When they have not been addressed, it's because they have not been causing problems up to that point. However, we're cognizant that moving forward, it could pose an issue. So what we do is we still close our loans even with properties with the bad panels, as long as we don't have a history of problems. Same thing goes for polybutylene piping or galvanized piping, which sometimes can cause problems. We do require our borrowers to fix those issues if they start popping up in the future. So during our loan term, if it turns out that the electrical panels start acting up, shorting or arching, they'll have to be replaced. But we do not, beyond requiring eventual replacement, there's nothing that would prevent us from closing a deal that has those features in them. Again, as long as we don't have a history of problems. If we go in there and there's soot on the wall from prior fire, well, we may not be able to do that loan. But short of that, we can.
When a investor owns a property, sometimes they look to do a refinance, whether it's a cash out or a partnership issue that they're solving. What is your recommendations for refinancing with this program?
This program is actually very favorable to refinancing. The most typical scenarios that I see are actually the ones you mentioned. Number one, a cash out refi, where a property was purchased a number of years ago, it was in disrepair, the new buyer has come in and done upgrades, increased the value of the asset, great looking property, worth significantly more than it was a number of years ago. You can come back to us, we will do a cash out refi based on up to 80% of the current market value. The cash out component, meaning the amount of cash that's get paid back to the borrower's closing, is typically not a concern once the buyer has owned the property for at least a year and a half. We deem that as this owner has paid their dues, if you will. They have invested equity, had the equity at risk, and have taken the steps to increase the value of the property. Now, the biggest determinant on a value increase for us is an increase in the net operating income. So an increase in value that's driven by cap rates or demand for properties does not really count on our book. It has to be driven by a tangible increase, a measurable increase in NOI. The other most common scenario that we see is partnership issues. Not necessarily an issue, but there's a partner that wants out. So the purpose or the use of the cash out post-closing makes no difference to us. So we routinely do cash outs where the purpose of the cash out is to buy out a partner. So it's a very common scenario and we can absolutely handle that.
When investors are using syndications or partnerships, how does that affect the loan program and how does Freddie Mac view that type of structure?
We have to be a little bit careful. We do take extra steps and there's a little bit of additional scrutiny when you have a syndication where most of the equity is being raised through third parties or other equity investors, but they're not very difficult. We do routinely finance deals where they're structured that way. Typically, what I'm used to seeing is we have a single sponsor who is the person who puts together the investment. They source the opportunity, they raise the funds from different investors, and they end up with an interest in the transaction. And they also end up being the general partner or the managing member. Typically, that person or persons would act as our key principal. They will sign the loan documents. They will provide any guarantees. Even though these loans are non-recourse, there are exceptions to that. So we have certain exceptions spelled out in the loan agreement. If a person violates one of those exceptions, then the loan could potentially be recourse. So when we look at our guarantors, quote unquote, if they meet our financial criteria of net worth and liquidity, then they can go out and raise equity and only own a smaller percentage of the entity or the structure of the borrower and still qualify. So they would have a 10, 20, 30% interest. The remainder of the ownership interest will be held by limited partners. And we can definitely accommodate that. And these limited partners do not have to act as guarantors. They don't have to sign the loan agreement. They don't have to sign any kind of documents. They may have to provide some basic information so we know who they are, but that's pretty much it. So we do see this almost on every larger transaction, and we do see it fairly common in the smaller ones as well. To inspect the property and do a property condition report and an environmental assessment report. Reports take about 2 to 3 weeks. Once we get those reports and we gather additional information from the borrower, we prepare a submission package which gets submitted into Freddie Mac for approval. That takes about 5 to 10 business days. At that point, Freddie Mac would approve the loan or approve the loan subject to certain conditions. And we in turn would issue a commitment to the borrower, committing to funding the loan based on the terms within said commitment. So that process all in, between the time the application is signed and the time the commitment is issued, takes typically between 4 and 6 weeks. So you must have that into account when negotiating your inspection periods and financing contingencies. We have been able to obtain commitments in a shorter amount of time. It is extremely difficult, and I would not recommend it. But typically 4 to 6 weeks is a very typical time frame. Sometimes they extend further than that, and almost invariably is because there's an issue on the borrower side. They can't get their entity set up for some reason, or there's an issue that they need to resolve and they need a bit more time. But as long as we have all that we need, and the attorneys are working towards closing, and we have our entities formed, and we have the information from the partners who are buying the deal, 4 to 6 weeks is a good time frame. Once we issue that loan commitment, at that point the borrower will accept the loan commitment, will provide us with an additional deposit that is refunded at closing, and then we can close within a few days after issuance of that commitment. So typical start to finish, it's 45 to 60 days from the day that the contract is signed and the loan application is signed to the day that the loan closes and funds. We absolutely recommend and almost require that the loan application be signed the day of the contract, because otherwise you are burning through your due diligence inspection period without allowing the lender to be also working towards closing alongside with your efforts. So if you're managing your time properly, you should be able to maintain the deal on track, and you should be able to close within the parameters that you negotiated up front.
What are the typical fees and costs that a buyer will incur during this process?
Sure. So the costs involved in financing a property are actually very similar across different lenders, whether it's a bank or Freddie Mac. The fee people ask the most is the origination fee. So lenders, in addition to the interest rate, we charge a fee, and that becomes part of the cost of the financing. The typical fee for a Freddie Mac deal is 1%, and it is pretty much non-negotiable. Now, in addition to the 1% fee, which many banks have as well, we have to pay for the appraisal, we have to pay for the engineering report. Those cost about $7,000 combined, which is very typical for properties of this size. In Florida, the buyer will have to pay for mortgage stamps and intangible tax. Those run about 55 basis points of the total loan amount. There's usually title costs, so title insurance. It could be between $5,000 and $25,000 depending on the size of the transaction. There's going to be legal fees on the lender side paid by the borrower between $5,000 and $7,000. And there's always some miscellaneous fees with respect to setting up escrow accounts and that sort of thing. The typical benchmark that I provide my borrowers is you can expect to pay between 1.5% and 2.5% of the total value of the transaction as additional closing costs. And that would include the fees for the lender, the fee for the attorney, title, mortgage tax. And it could vary. Some sellers also negotiate things as deed transfer tax. Sometimes in Florida it's paid by the seller, sometimes it's paid by the buyer. It's really up to whatever it's agreed upon during the contract negotiation aspect of it.
Dennis, thanks for coming and sharing your insights with all our audience. Appreciate it.
My pleasure.
Thanks.